Hi, Phil Weiss of Price Wealth Management here with a video summary of this week's blog, Health Savings Account, the triple tax-free retirement benefit. It's actually not a new blog. It's one that I've updated for changes in IRS limits in 2022. Why do I think it's worth re-releasing this blog? Because it's an important topic. This blog is one that I refer clients and prospects to probably more than any other. That's number one. Number two, when I have my Apprise's 5 favorite reads, it's also a topic that I look for other articles on just to constantly remind people of the importance of HSAs and how much of a benefit they can provide. So let's talk a little bit about health savings accounts and what I mean by a triple tax-free retirement benefit. You put money into an HSA, you get a tax deduction for it. You can then invest that money and hopefully watch it grow. And that growth can also be tax-free. And as long as you have qualified medical expenses that apply, when you withdraw money from your HSA, you can withdraw it tax-free. So that's why it's a triple tax-free retirement benefit. That's better than you get with your 401k or your IRA, because on those, you only get a double tax benefit. You pay tax on the money when it comes out. It's also better than a Roth. There you get a double tax benefit. You pay tax on the money that goes in. The HSA has the advantage that there's no tax on the money that goes in or out. So it's the best of all worlds. In order to contribute to an HSA, you have to have a high deductible healthcare plan. What does that mean? It means your deductible has to be $1,400 for singles, $2,800 for married, at least. Your out-of-pocket expenses can't be more than $7,050 for singles, $14,100 for married couples. How much can you contribute? If you're single, you can contribute $3,650. Married couple, $7,300. If you're over 55, you can put in another $1,000 for yourself and another $1,000 for your spouse. Now that one's a little bit tricky because when you have an employer plan that you're doing this through, you can only put in $8,300 for yourself and your family. If you wanted to make the extra $1,000 contribution for your spouse, it has to be done through a separate account. How can you use the HSA? You can use it to cover qualified medical expenses that were unreimbursed that you had during the time that you had a high deductible healthcare plan. So you can have expenses this year, not pay for them out of your HSA, and in 20 years, if you have documentation or receipts, and that's an important part of this, to support that you have these unreimbursed costs, you can take the money out in the future. A young person that has an HSA, in theory, could get to retirement or some future point and be able to use the money in an HSA if it was contributing the maximum every year to pay for something like a car. Maybe that's not the best idea, but it is a possibility. You can also use it to pay for Medicare and other insurance expenses when you retire, things like that. Just have to be careful because there are some limitations around what happens with the account that makes it a little bit less favorable when you pass away than your IRA or your Roth would be. But those can be overcome by just making it a priority and spending this money when you retire. Also, if you're Medicare eligible, you're no longer able to contribute to your HSA. You can make contributions after year end, just like you can for your IRA or your Roth. So in January, you could make a contribution for the year that just passed. You just have to make sure that when you make that contribution that you identify it with your brokerage so that they know which year it applies to. It's also very important, as I noted, that you keep receipts or some type of documentation of the expenses. So that way, if it's ever questioned by the IRS, you can say, here's the expenses, this reimbursed. Remember HSAs, they're an important tax benefit. They can be an important part of your financial plan. They're more tax favored than your 401k, your Roth, your IRA, your Roth 401k, because HSAs provide that triple tax-free retirement benefit. Something really important to keep in mind. It can be an important part of your financial plan. If you have any questions about an HSA or how it can work, you're welcome to reach out. Also note that one other difference with an HSA, there's not these limits in terms of when you can move the money. You can do it anytime you want. There's not limitations on how many times you can move your HSA to someplace that allows you to invest it. Also, anytime you can do it on a regular basis. You can move money out of your regular HSA into one that you can invest, because a lot of employers don't provide an HSA that you can invest with. You just know to keep in mind that oftentimes the place that you have the HSA, even when you're investing it, is going to make you keep a minimum balance with it. Hope you find this blog and the updated information helpful. I'll be back again with my 5 favorite reads of the week next week. Have a great day.